After you understand the basics of financial statement, you want to use the information provided in financial statement to analyze the company, right? In this video, I'm going to do exactly that. I'm going to provide you the general framework, tools, and the techniques used in company analysis. This is a very general framework in the sense that I am not going to provide any numerical example to illustrate the case. Please keep in mind that how you analyze a company depends on why you are analyzing. What I discuss here is a very general framework, although it might be more useful in the valuation of a business, because we want to focus on the valuation of business in the next modules. So let's start with a very general question. What are the key steps people follow in the analysis of a business? And there are in general 5 steps. Step 1, whatever company you are analyzing, you have to understand the business and the industry and what the company is doing. And this is usually covered in your management or in strategy class, so I'm not going to talk about it here. The second step is you look at the 3 major corporate activities: how they are investing, how they are financing, and how they are operating. All of these 3 major activities impact the overall value of the business, right? Third step, determine the current and future financial health of a business. This is pretty much like if you go to a doctor, nurse collects some information before you really see the doctor, right? So exactly that's what you do in your step 3. You look at the current and historical financial health of a business just to figure out whether it is in the normal condition or it needs some sorts of deeper diagnosis. So that's a third step. And fourth step, what you do is use your historical and current information and also their strategic initiative and forecast the financial information. And finally, you use these financial statement to value the business. There are usually 3 tools most commonly used in introductory finance class. One is the ratio, right? Second one is the common size analysis, and we also use chart and graph in order to analyze a company. So I want to start with the ratio analysis. And what do you do in the ratio analysis? You calculate different kind of ratios based on your objective. What do you want to look at the company? And then you compare that ratio over time and across industries. So and then you make your decision. So based on this common size, you compute the common size income statement and common size balance sheet, and you look at how different accounts are changing over time, and you can also compare how these different accounts compare to each other. It could be your competitors or it could be with the industry. And sometimes this chart and graph are used in order to depict the important information from ratio analysis and common size analysis. So I want to start very briefly the ratios. And as you know from your BA 250 class, towards the end you have covered different ratios, right? And this is what these ratios are here, and I'm not going to talk in detail about these ratios because this is a video. I don't want to make long video. And broadly, these ratios are divided into 5 categories, right? One kind of ratios are usually the liquidity ratio, and they usually answer the question like, can we make required payment? And the second kind of ratios are asset management ratios, and that measures how these assets are being utilized. And there is a solvency or the debt management ratio. It basically measures whether there is a right mix of debt or equity or not. And profitability ratio, as you all know, that basically measures whether the business is making a profit or not, and finally the valuation ratio, and it basically measures how much the common stocks is price as compared to different fundamentals of the business. And next, what I want to show is different ratios. So here are some of the ratios that I want you to learn, and I want to start with the profitability ratios, right? So these profitability ratios measure a company's ability to generate an adequate return on invested capital. And there are different ratios I want you to get familiar with, starting with net profit margin, EBITDA margin, return on total assets, return on equity, earning per share, and assets turnover. And how to compute each of these ratios, I have given the formula, right? You can find these information from one of the financial statement, and you can put it here and you can calculate. What is important I want to emphasize here is, how do you compare the performance of your business or your company with the others? So the couple of ways you can do. So one, you calculate the same ratio for 3 to 5 years in the past, and then you also compute this for industry and the market, and then you see how this ratio is changing over time, and also you can compare how it compares with the industry. That's a general framework of ratio analysis. And this is about this profitability ratio. Similarly, I have here short-term liquidity measure ratios, right? Current ratio and the quick ratios, and how to compute. I have given the formula and you might already know it. So these liquidity ratio measure the company's ability to meet its short-term cash requirement, right? Again, how you do analysis, you compute those ratios for some years and compare with the industry and the market. And now we have long-term solvency measure ratios, right? And these ratios measure a company's ability to meet long-term debt obligations. And three of these ratios I have pointed out here: book debt to equity, debt to capital ratio, and debt to enterprise value. Please pay attention to these three ratios and compute this ratio for the company assigned to you. So another ratio is the valuation ratio, which is the most important for our class. And these valuation ratios measure quality of an asset relative to company fundamentals. And four of the ratios I have pointed out here. Please make sure that you know how to compute them, and I'm going to provide this some worked out examples to compute these ratios. These are price to earnings, price to book, price to sale, price to cash flow. See, everything is compared with the price. Some with the book value, some with the price, some with the earnings, right? Again, when you do analysis, you compare for the last few years, and then industry, and then you compare with the market, and then you compare over time and across industries and make your decisions. So after that, I want you to learn one important identity in finance, which is called dewpoint identity. What it does: dewpoint formula says that a firm's return on equity is the product of profitability, asset turnover, and financial leverage. That formula is very well known in finance. So as a student of introductory finance, you must know this one identity. Return on equity by formula is what? Net income over total asset, right? But you can rewrite that equation and then this way, and that is a relationship which says that return depends on three important factors. One is the profitability, another one is the capital intensity, another one is the leverage. So keeping any of the two items constant, if you change one of them, for example, if you keep the profitability constant, capital intensity or the assets turnover constant, if you change the leverage, there is an increase on the return on equity. That means more debt is good, but that is not the real scenario in real life. Sometimes more debt might not be good. Another tool we have is common size financial statement. And in this common size financial statement, what we do is we can express each item in income statement and balance it as a percent of total revenue or total assets, and then see over time, and you can also compare that across different firms. So I have provided one example here. So that example here is so here is an example of common size balance sheet. I have all these balance sheet items, right? And for the last 5 years, I have the information here, but they are not the exact dollar amount. All these dollar amount is expressed as a percent of total assets for that year. So if you want to compute the cash and short-term investment for year 5, then what you do is you divide the cash and short-term investment for year 5 by total assets of year 5. So when you express all these items as a percent of total assets, then you can see what is happening that specific item over year. For example, inventory as a percent of total asset, whether it is increasing or decreasing, or whether it is staying the same. So this kind of trend analysis is very easy when you express these all items in income balance sheet as a percent of total assets. And this is very important when you have to make assumptions about the future growth of these items, and which is very useful in the valuation. The final tool we have is chart and graph. And you are familiar with this kind of tools because we have been using for all the time, right? So we can also use this like a pie chart, histogram, and line chart in order to compare between different companies, or also we can use this kind of graph to compare the performance of the business over time. And here's an example. I have used this pie chart to compare the capital structure of two companies. TGT stands for the Target, right? And WMT stands for the Walmart. So this is the capital structure of Target and capital structure of Walmart. So we don't have the number here, but looking at this picture, you can say that Target has a lot more debt than the Walmart, right? So this is how it makes easier for us to compare. And similarly, you can use some other kind of graph. For example, I have created a graph to look at the P ratio over time, right? Like a P ratio over time, and I also looked at the P ratio for the S&P 500, so you can compare the P ratio of your own company against the market. Similarly, I have also looked at the price to book ratio over time, and you also compare this with the market, right? And I have also here a bar diagram to see the return on asset, return on equity, return on invested capital over year. So the idea of this example is to show you, yes, these are the tools people often use it in analyzing company, and you as a student of business, you should also be able to use this kind of tools in your analysis. I hope it makes sense. Thank you.